Can we take our fund public at some point in the future? That is a really great question. It's a question that came from one of our clients, one of our symposium alumni who is running a fund. They want to raise more capital. They want to raise it a lot faster than they can raise it privately. And so they called and they asked if they could do that. Well, first of all, the answer is yes, they can do that. We build this sort of thing into the documents that they have the ability to do this. This is an advanced technique. In fact, I'm not aware of anyone else from the symposium environment that has done this, although a few people probably would be eligible to do it because they've been very successful and they're at the level where they could probably take their companies public. But for the most part, it's not something that happens very often. But that being said, it's something that we build in on purpose. Now, let's talk about what this all means. There are a couple different ways of going public. What most people are familiar with is an initial public offering, an IPO. What that means is you go to the regulators, you tell them you've got a company and you want to put it on the stock market exchanges. They examine you, you get audits and all the kinds of things that have to happen. It costs at least $1 million for a small company to go public. And then there's enormous costs of keeping that company public over time. The way that we're talking about, what this gentleman called and asked me about, is called a reverse merger. And a reverse merger is something that was cooked up by the investment bankers some years ago. And what happens is that when a company gets sold, like a public company gets acquired by another company, the investment bankers will strip out all of the assets. And those assets include all the inventory, the accounts receivable, all the different things. But one of the assets that you don't always think about is that the corporation itself, the shell of that corporation, now that everything's been pulled out of it, is an asset, especially if it's public, because it already went through the process of becoming listed on an exchange. So frequently these things will get washed through a bankruptcy court to remove any of the skeletons in the closet and make sure that there's no liens, judgments, or other kinds of things that could pop up at some point in the future. And then the investment bankers will sell these shells to companies that want to go public. So this gentleman is thinking about buying a shell. And this person would buy the shell. The reason that they would do that is because it's a quick way to go public. They can be listed now. So it deals with the liquidity issue in our business. The biggest threat, the biggest risk in the private placement business where we operate is not so much that the real estate is going to go south or something's going to be bad. It really is that if the investor needs to get out of the deal, they can't get their money out. It's illiquid. This is well known to be an illiquid investment. We advise clients of that all the time. They may not think about it at the time they're buying in. And then they'll come to you and say, listen, can I get my money back? I need to get out of the deal. And you may or may not be able to let them out based on how much cash you have and the nature of your asset base and so forth. But in a publicly traded company, they can put their stock for sale and another person would buy it without affecting the cash balances of the company that's being sold. So the fund would not have an effect in this way. So it makes it easier for certain kinds of entities to invest. Private equity companies might invest because they can get in and out if they need to. They don't get stuck in the transaction the same way that they would be stuck in it in an illiquid situation. So there are lots of reasons to consider it. There's also, some risk here. I mean, this is not a perfect situation. So for example, it's quite expensive to continue to operate. It's not that expensive on the front end like in an IPO. Maybe the shell is some number of thousands of dollars to hundreds of thousands of dollars, depending on the nature of the shell, the nature of the listing, of the exchange that it's listed on, and so forth. So there's a lot of factors that investment bankers put into the deal. But it also, there's some risk about, raising the money. I mean, if you're going to put all this money up, are the investors really going to put their capital in? And frequently the investment bankers will procure that, and they'll procure it for a fee. I mean, so it's not inexpensive to raise your capital this way. So you have to be very clear and sure that you're capable of deploying the capital that you raise in this way. So taking your company public is an interesting idea. It's certainly not for everyone, but for some people who get to a high level, that get to a place where they can deploy a lot of capital, that need to raise a lot of capital or continuously be raising capital, this is something that they might consider. So if you buy these really cheap documents from a really low-end attorney, you're absolutely not going to have these options built in. The medium customized stuff, the stuff that the higher-end stuff like what we do build these type of options in, because better to have the options available to you than not have the option. It would really be a bummer for you to want to do something that you can't do in the future because it just didn't get built in because somebody wasn't thinking ahead. But that happens all the time, and that's life. So We try to think through that because we've been down this path quite a lot of times and we've seen a lot of stuff. Even though this particular thing hasn't really happened, we still build it in the docs because it's something that other kinds of companies, usually not real estate, but venture-related companies will take advantage of. So just something to think about. You can absolutely take your company public. Just think about that in advance. Think through all the issues. An attorney has to supervise this process. An investment banker probably has got to be involved in supervising this process. There's going to be a lot of promises made and a lot of issues and a lot of concerns that you're going to need to think through, much bigger than we can discuss in a little video like this. But this is something that's interesting. And if you are interested in it, certainly you can call us and we can point you in the right direction. So think through it because this is just a great business. Now go out and stake your claim.